Elsewhere at Pimco, they're releasing their mid-year cyclical outlook, with Chief US Economist Tiffany Wilding expecting peak policy, peak growth and peak inflation to converge, writing, quote, "With the pandemic receding, policy support has likely peaked. Inflation in developed markets will peak in the coming months, with the exact timing and magnitude uncertain. And growth would also likely peak in the second or third quarter of this year as the pandemic fades." Pimco's Tiffany Wilding joins us now for more. That outlook, Tiffany, does that inform policymaking, or is policymaking informing that outlook?
So I think that it's a bit of both, right, Jonathan? So what we've seen, obviously over the last year is that we've had this very large negative shock to developed market as well as emerging market economies, the pandemic, and we've seen a policy response that's been very large in magnitude, particularly large in the United States. So now that the pandemic is fading, and we do think that global new cases for the pandemic likely peaked in April. We do think developed markets do get to a place where the majority of their populations are vaccinated. You can continue to get some decline in that new cases. But as that's peaking, so is what we call the policy impulse. So in particular in the U.S., we think you have seen this policy impulse peak, with the fact that the stimulus payments to households that were happening in March and January of this year, those are not likely to happen again. And in addition to that, we've already had the Biden administration come out and say the enhanced unemployment benefits, they're going to expire, as is currently written in law, in September. So really the outlook in our minds is about this handoff to policy-induced growth, to more organic growth as the economies reopen, and as things get better.
Tiffany, can you give me a better idea of the scale, the magnitude of deceleration from this year into next, from next into the year after, that you're expecting in GDP growth?
Yeah, so we're on a global basis, we're forecasting GDP growth this year around 6%. And we think that's going to decelerate to closer to 3% in 2022. And that's really led predominantly by the United States, which is we're looking for 7% growth this year, coming down to 3%. So, this is still going to come down to above trend growth. But ultimately, we're going to start to see some pretty big deceleration. And we think that this kind of inflection point, can be important to markets, and can create some market volatility, in the interim.
What do you think it means for the Fed, that scale of deceleration that you're anticipating?
Yeah, ultimately our view is that central banks, including the Fed, will pretty much stay the course, at least over our cyclical horizon, which we're kind of looking to now to 18 months out. So we're not forecasting the Fed to increase interest rates until the second half of 2023. That is in line with what they expected in their latest projections, or what the median expected. But we do think that there will be some time for the Fed to kind of reassess in 2022 as things kind of settle down, and as inflation peaks. And ultimately they won't start actually removing policy, until after our cyclical horizon.
Tiffany, if you worked out how quickly you think we'll erode this slack, it feels like the trillion-dollar question, the slack in the labour market. What happens with the participation rate? It seems to me there's a lot of uncertainty around that still. Where are you and the team focused right now?
Yeah, and we would absolutely agree with that. So Fed policymakers have focused on the fact that there's still, call it around 8 million jobs. The economy is 8 million jobs down relative to where it was pre-pandemic. So the question is where did those people go that were employed? Many of them went to unemployed, obviously, but also they went to out of the labor market. And they said they were retired. So I think that's really the key question here is given that, around 2 million of those folks went out into retirement, they're probably not likely to come back. So where else, kind of labor market slack, where else can we get that additional slack to come back? So I think we're really looking at and focusing on the prime age workforce. Prime age participation rates also declined in this pandemic. We think that they can recover, and you can even see some recovery in it above and beyond where we got to in the last cycle. I think the policy considerations of this administration will also be important here. To the extent that there's a focus on, getting people back to work through, policies like enhanced government benefits for child care costs and things like that. I think that can go a long way to get prime age folks back into the labor market. And that's ultimately, I think, where the uncertainty is, though, and that's what we're going to be looking for.
I'm looking for a date in the diary maybe near the end of August, the start of September, to really get a clean read on this economy. A lot of people are focused on September, Tiffany, because, as you know, the additional unemployment insurance expires. It's back to school, which could do something for childcare and the participation rate. Is September the date in your diary? Is it a month after that, Tiffany? What's the placeholder for you?
Well, I think for the U.S. at least, I think we have likely seen peak growth at least on a sequential basis in the U.S. So we are looking or tracking growth in the second quarter to be over 10%. We actually think that probably moderates down in the third quarter. So we actually think you're seeing it now. Now in terms of the extent to which you're seeing a slowdown, yeah, I do think that in the back half of the year, September, that's going to be very important. Not only from the growth perspective, but I think also from the policy perspective. Now I mentioned peak policy, and talked about the government side of this. But of course, monetary policy is going to be important here, too. We sort of alluded to that. But tapering, the discussion of that, has really started at the Federal Reserve. And I think September is going to be kind of a key time to really understand when the Federal Reserve is deciding to announce tapering. We think that there's a risk that the policy actually is announced in September. The December meeting is probably the more likely meeting. But I think that September timeframe will be key for Federal Reserve members as well to kind of understand or to try to help them assess when they're going to announce, their tapering plans.
Tiffany, just before you run, that's kind of out of consensus. A lot of people think it might start in December. You're saying it wouldn't be announced until December. Is that right?
Well, no, we think that, announced at the December meeting and then effectively started, very much soon after. We think that's kind of a base case. But I think, the risk here is probably September. I think that there's, an argument to be made, that kind of starting this ahead of time is a way to manage inflation expectations. I think since the Fed is more focused on upside risk to inflation expectations now, maybe getting the program over faster than markets currently expect, that just increases the Fed's optionality later. And it might even increase the runway and allow the Fed to, to kind of wait and see, take a more wait and see approach on hiking interest rates, consistent with our view that, 2023 is the more likely outcome for that.